Hi, this is James Rickman. I'm doing a piece here on my global economic analysis. Enjoy the clips ahead. There's also a blog. Take a look at my article, some of the charts I've got there, and have a great day.
This is a hard
Hi, this is James Rickman, the director of iHumanEvolution.com. Today my topic is Fed QE3 coming. U.S. equities reach 2012 high. China and India slow. Euro economy is dysfunctional. The global economic data I'm finding is clear as we see banks like JP Morgan, Goldman Sachs, Sony, other companies such as that are reporting disappointing earnings. We're starting to see that creep into the marketplace now. We're seeing Europe and Asian markets have, particularly Europe, is basically crumbling. Asia has slowed tremendously. We're seeing that, for example, India's output fell 3.5% just recently. We're also seeing the breakdown of Italy, Greece, Spain, France, all weakening. The sentiment among analysts appears to be turning negative, as I've seen Volcker, Bill Gross from PIMCO, the bond fund king, and Mark Faber have all begun to shift their, and have been over the past couple months, shifting their portfolios out of emerging markets and sovereign debt and looking towards other investments. For 2012, I also found the International Monetary Fund report shows a global slowdown. The market cannot maintain its current momentum without some massive Fed QE3 stimulus. However, the political headwinds in America are negative on pumping more money into the economy by offering U.S. Treasury bonds. It's a strategy we're seeing now of kicking the can down the road and increasing debt further that will have a major impact on the ability of future generations to generate and create new jobs, upgrade education. Personal financial savings will be hampered, which also will affect the housing market further. If the economy deteriorates and continues on this path, we may be looking at a very tough 2012 economic election bid for President Obama. It could benefit presidential candidate Mitt Romney, as the focus is on jobs, economic fiscal policy, in the upcoming election. Romney is a budget hawk, would cut the size of government and reduce spending by accelerating small business innovation and investment into small businesses, probably simplifying the tax code, which would create new jobs as well through private sector investment. Couple this with a foreign trade policy shift to make the trade policies a little more favorable to middle class Americans. The euro cannot be artificially stimulated forever, so we may see a shift over the next 2 years or so, where Spain, Italy, Greece, and France retreat back into their own currencies again. Germany would be left then to remain the de facto keeper of the euro, used similar probably to US dollars as they're traded in, let's say, South America or something as a currency for trade. Such a plan would allow for easing in the write-down of sovereign debt in troubled European countries if they were to break apart from the euro and retreat back to their own currencies. The governments in Europe must also provide jobs and economic opportunities to the people there. Otherwise, civil unrest will prevail, as we're seeing throughout the Middle East. As the economic situations become more and more unstable and deteriorate further in Europe, we'll be seeing the people will put more and more pressure on those governments to find sustainable solutions, which pumping more money into the economy there is a never-ending path to disaster, basically. The global economic outlook has slowed rapidly. We've also seen the price of oil drop. Commodities are dropping, meaning that output is lower. Equities have dropped further, indicating a significant slowdown in the output. Companies are reporting decent earnings, but it cannot be sustained as the markets slow, particularly with emerging markets. Retreats will be pronounced in the coming months. The U.S. debt is now $15.7 trillion. It's about 104% of GDP. Another round of a Fed quantitative easing policy, QE3, would push the U.S. debt somewhere up around 120 to 130% of our GDP. Such a strategy could result in the downgrade again of the U.S. credit rating, which would also impact the bond and equity markets. Interest rates would rise with the downgrading of the U.S. credit rating. Higher interest rates would also impact U.S. job growth opportunities that would erode and impact the unemployment rate, of course, would probably increase. That's what we're seeing ahead for 2012 and 2013 early on, depending on how the election goes in November. Where to invest for 2012 and 2013. The price of gold is about $1,583 per ounce. But with Fed QE3 in the works, we could see gold prices rise as sovereign debt becomes more risky. Another investment play I like is high-tech and healthcare equities that pay healthy dividends, like Intel, Pfizer, IBM, Procter & Gamble, Microsoft, Boeing, Siemens, Caterpillar, and Eli and Company. I like those, all of them. High dividend yield equities like Kinder Morgan Energy Partners is also a great investment and gives you a nice return. Seeking long-term gains in financial bank equities, I would look towards the Royal Bank of Canada and the Canadian Imperial Bank of Commerce. All smart investments. Thank you and have a great day. This is James Rickman.